Great. So let's get started. Welcome to everyone. This is the FAST-Infra Label webinar on standardization to scale sustainable and resilient infrastructure. We've got a great panel installed for you today. I'm Louis Downing. I'm the CEO of the Global Infrastructure Basel Foundation, or GIB for short, and I'm going to be moderating today's panel. The objective of today is basically to present some examples and applications of how standardization can lead to more resilient infrastructure and applications and support sustainable infrastructure as an asset class more broadly. So these topics are really central to our work here at GIB, especially in our role as Secretariat of the FAST-Infra label. But we'll get to that a little bit later. First, let me introduce our panelists who are already up on the screen. I'll be as quick as I can. We've got a top lineup of great thinkers, starting with James Dunham, who's the Sustainability Director at Delmore Capital. Natalia Mudrak, Managing Director of Climate Risk Advisory at Aon. Darius Nasseri, Senior Fellow at Columbia Center for Sustainable Investment. And finally, Christian Desigles, former HSBC Group Head of Sustainable Infrastructure and Innovation and a GIB board member. So James, Natalia, Darius, and Christian, thank you very much for joining us today. Now, before I hand over to Christian, we do have a Q&A session at the end of this webinar. So we'd encourage you to start gathering your questions as we go through. Drop them already in the Q&A section, and we'll answer as many of those as we can when we get to the end. And we hope that that's a way that we can also continue the discussion with you after this webinar. So over to you, Christian, for a quick presentation of FAST-Infra.
Thank you very much. Thank you very much, Louis, and great to be on this panel and to be joining you this morning. It's a pleasure to open the panel on FAST-Infra. So for those who don't know me, and Louis, you mentioned I was the Group Head of Sustainable Infrastructure and Innovation at HSBC, and now I'm on the board of Global Infrastructure Basel, and still very much involved with the label and the FAST-Infra group. So, Giulio, can we move to the next slide, please? Great, fantastic. So, a word about climate finance. So, as you know, this year we are celebrating 10 years of the Paris Agreement. And the good news, as you can see here, is that climate finance has actually more than doubled in the last 6 years. The sobering news and the reality is that we're still well below what is needed to stay on track with the net zero trajectory. And when we talk about climate finance, I think it's important to understand that we're talking a lot about infrastructure finance. And in fact, infrastructure sits at the very heart of the challenge of rewiring our economies, because it does underpin economic and social development, but it's also what we need to decarbonize, and it's also where climate risks are hitting the hardest. So we're going to move to the next slide. It's a little difficult for me to talk about climate risk and the cost of economic losses in front of Natalia, who is the expert in the field. But I think what's important to remember is that non-resilient and aging infrastructure is already costing us a lot. In 2024 alone, the disasters that we went through caused approximately $320 billion in economic losses, and about only 40% was actually insured. And what's important to keep in mind, I think, is the fact that investors in infrastructure, which is not sustainable and not resilient, could face losses of more than 50% under current policies in their portfolio. But the hopeful message, I always try to balance, some of the risks we're facing with more hopeful notes. When resilience is embedded from the design stage in the construction and design of infrastructure projects, its benefits far outweigh the cost, and often in a ratio of more than 10 to 1. A few months ago, back in April, we published a white paper with ORTEC, with input from the BIS and Aon and others. And this paper is actually really important, and I hope you can download it because it shows that sustainable and resilient infrastructure can actually outperform conventional infrastructure by 20 to 30% over a period of 15 years under various net zero scenarios. And what's important also is that adaptation and resilience measures alone can reverse up to 50% of physical climate risks. So I think the conclusion of this paper is pretty clear that resilience and sustainability are not only about reducing the risk, but they are very much about value creation, improving performance, insurability, and longevity of assets. So how do we, look going back, and Julio, can you maybe go to the next slide? That's a very busy slide, but the question is, how do we channel capital at scale to the right kind of infrastructure? And I think that for the market to scale, investors need confidence. And in order to act with confidence, you need tools which investors can trust. So you need credible standards, you need verified data, you need benchmarks that will allow you to do some cross asset and cross market comparison. And this is exactly what the FAST-Infra label is providing. So it's providing a harmonized framework, which is drawing on 55 global standards and taxonomies. I mean, just remember that number. There are 55 standards and taxonomies out there that have been mapped against the label. It provides also a clear definition of what sustainable and resilient infrastructure actually means. And then it also has a portal that has been developed by Bloomberg that enables developers and financiers and contractors to actually apply the framework to real projects. And the last thing I would like to say about the label, it's not here, but it does include a capacity building facility that is available to project developers and that will help them design and build the infrastructure according to the features and the framework of the label. So really important to understand that from design to operation, the label actually evaluates exposure to physical risk and transition risk, as well as long-term community impact. This is what I would call the next generation sustainability, where it's not only about the transition to net zero, but it's where durability and resilience actually meets performance. Do we maybe go to the next slide, Julio? On the uptake of the label. So another piece of good news here is that momentum is building. There are more than 55 projects across multiple geographies that have been labeled already, representing over $20 billion in capex. I think we are at 24 billion now. So many projects across many countries that have been already self-assessed against the label. And it's really good to understand that developers, financiers, asset managers are actually using it for gap analysis, for internal alignment, as well as for portfolio credibility. Next slide. This one is just to give you a sense of the ecosystem around the label. But really what's important is to show that we have here all the key stakeholders of the infrastructure ecosystem. And the central message is really creating comparability in order to reduce due diligence cost, in order to embed resilience, and therefore to de-risk projects. And the important thing also is that as we do that, we are expanding the pipeline of investable opportunities, particularly in emerging and developing countries, where the lack of a bankable project pipeline is very acute. And so, the goal of having all those players in the ecosystem is really to move infrastructure assets towards some kind of a financial product. And to get a financial product, it means standardized contracts, it means performance data, it means aggregating data, enabling benchmarking and reporting framework. So it means bundling and securitizing projects, creating secondary markets, and also reducing transaction costs. So this is really the purpose of the FAST-Infra initiative, to help transform infrastructure assets into an asset class. And that's why the development of the FAST-Infra label is so important, because we have here the supporting tools, the building blocks that can allow us to build a market. Next slide. Oh, that's it. That's it. Okay. I thought we had a slide also on the labeling process. But if you have any question about how we go from submitting a project to actually getting it labeled, please contact the GIB Secretariat, and they will be able to give you all the details. So just as a summary, I think we've got, as I was mentioning, the building blocks in place. We've got the ecosystem around the label, and I think the system is now ready to scale. So please send us your submissions, and let's make it an industry standard. Thank you.
Thank you so much, Christian. No, that was great. And the volume of uninsured losses and the way that they're increasing is just staggering. So with that as a backdrop, Darius, let's turn to you. Let's launch straight into our panel. You've got a really huge volume of experience in the sustainable infrastructure space. And as mentioned by Christian, on one side, we've got this infrastructure gap. So we really need to build. On the other side, developers are bearing, some of the highest risks when it comes to developing infrastructure projects. So could you speak to us about how can standards and aligning good practice help de-risk early stage project phases, and how can they contribute to projects moving from concepts to financeable assets?
Great. Well, thank you. And it's great to be here, Louis, and a pleasure to see James and Christian and Natalia as well on this panel. And thanks very much for the opportunity to join this discussion. As Christian said, we have a big challenge in front of us. As anyone who's dipped their toes in climate finance will hear from anyone who's working in this space, one of the key challenges is a supply of investable opportunities. Over the next decade or so, we will require over $100 trillion of new or improved infrastructure. Much of that will be in the developing and emerging markets because of their growth rates. That's energy, transport, logistics, defense and security, water, agriculture. A vast array of infrastructure will be constructed over the coming decade or two. And we have a choice as to how we build that infrastructure, prepare it, and make it presentable to investors. I think taking a step back to understand the value and urgency of the standard that you have put forward, it's worth bearing in mind that we face a number of critical deadlines as a global community. We are already at 425 ppm CO2 in our atmosphere. We learned just a week or so ago from Potsdam Institute that we're breaching 7 out of the 9 planetary boundaries. And the choices we make over the coming years will be decisive in terms of how we survive into this century, not only in terms of infrastructure losses, but economic performance and growth prospects. That's why I think the value of the label is so significant. To Christian's point, it not only reduces transaction costs and helps financiers and developers find a shorthand for sustainability and resilience, but it also greatly reduces the cost of coordination among the various parties. Now we have a common shared language, a meta standard, to understand the sustainability and resilience dimensions of infrastructure we are investing in and building. We also greatly reduce the amount of time it takes for learning on how to produce this infrastructure in a sustainable way. It shortens the time frame to use a standard such as the FAST-Infra label. It also significantly enhances the ability for a wide variety of participants to reduce the capacity building time required to come up to speed on the highest standards for global participation, global standards in infrastructure. And finally, as I mentioned, the coordination mechanism is provided by the standard in the sense that now multiple parties can speak to each other using the same language. So there are a number of benefits of using this kind of meta standard for sustainable infrastructure that are highly valuable and time sensitive at this juncture. And we would be very well advised as financiers, investors, project developers, development practitioners to notice the standard, adopt it, and promulgate it as widely as possible. Because with this in place, we have a much better chance of meeting our global goals, providing a safe and resilient future for the next generation. And to Christian's point, reducing the level of unnecessary losses due to extreme weather events that we're already experiencing. So for a number of reasons, I think it's a very important moment to notice, adopt, and promulgate the standard that you've provided to the world as an extremely valuable public service.
Thank you, Darius. Let's now turn to you, James, for a very different perspective. So you work for Delmore Capital, an asset manager, mainly investing in the UK, and as a GP, you sit between projects and the source of capital. So we've worked with you for some time now. We know that impact is a really important investment component for Delmore. So looking first at the GPs and their investments, how can sustainability standards support investment decisions?
Thanks, Louis. And again, thank you for inviting me to speak on this topic. I feel like there's a real role for standards, and as I'll describe just now, that we've very much looked at this from our own perspective. How can it feed into our own investment decision-making process? And the foundation of that is really our responsible investment policy. That's the sort of central pillar to how we look at sustainable finance. We look at risk to sustainability, and that underpins our governance of sustainability as a topic. And we take a pragmatic, purpose-driven approach, which anchors our fiduciary duty to act in the best interests of our clients, together with delivering those real-world outcomes. And this is fundamental because we need to think about financial materiality of climate and sustainability factors in our investment decision making, as well as our asset management. And this isn't just a regulatory requirement; it's a strategic necessity to better align with our investor expectations, manage financial risk, and ultimately unlock long-term value in the assets we reinvest in. And our responsible investment policy, for anyone has seen it, provides a clear framework for how we think about sustainability within the investment cycle, from fund formation all the way to exit. And the FAST-Infra label is a core part of that, recognizing that financial performance and sustainability are fundamentally linked. So thinking about that beginning of the process, thinking about fund formation, capital raising. So it's really important to consider standards at that stage. It's more thinking about sustainability because it helps us frame sustainability in more beyond just a compliance exercises. It's a strategic lever for building trust, attracting capital, and delivering enduring value. And there's a number of advantages of thinking about sustainability and the role of standards in that broader fund an investment strategy. And the first one of those is signaling commitment. I think by having standards at the core to your fundraising, you're signaling that intention to the market that you're around your dedication to sustainability and responsible investments. And fundamentally, we're in the business of investing institutional investors' money, and we want to attract investors to our funds. So, having a robust sustainability strategy underpinned by credible standards can increase funds' attractiveness in our experience, and particularly linking those to investor sustainability mandates at the same time. And as well as attracting investment, there's dedicated capital pools towards sustainable and impact-focused investment, and standards, particularly robust evidence-based standards, can help unlock those opportunities. And from our perspective, that we feel sustainability and voluntary standards can be a real market differential when it comes to the fundraising and differentiating asset managers from the competition. So that's fundraising, that's very early in the process, but this very much continues throughout the investment cycle. So when we look at acquisitions, so good example, if anyone follows us on LinkedIn, we recently acquired a hydro portfolio, which was labelled using the FAST-Infra standard. And it's not only in terms of communicating that positive impact, it's a fundamental part of our diligence of the asset, how we screen, how we appraise our investments when thinking about sustainability, contribution, and also risk. And as outlined in our responsible investment policy, the way we think about sustainability is looking at the contribution, that sustainability objective, against a variety of frameworks, which include FAST. Then also are the material, environmental, and climate risks, and informing that assessment. And FAST was particularly useful in terms of almost providing that checklist of topics to cover off that to inform our diligence. And not only looking at the asset, looking at the governance, looking at the portfolio company's governance from a sustainability perspective. And again, there's a fundamental role for standards within that process, looking at policies, procedures, social safeguards, and as I said before, we often complement different standards. So using FAST, thinking about IFRS, ISSB, S1, S2, and other standards to help shape and inform that process, and ultimately identify financial material issues to inform that targeted mitigation to ultimately inform the IC process. And then in terms of our asset management, post-acquisition, we very much continue this process. So whether that's assets where we have control, where we're able to implement bespoke policies, procedures, or whether these are minority investments where we secure governance rights and able to influence, we very much follow the same sort of process. And I think what's telling our story of how we've engaged with the label, when I joined Downmore, many of our assets hadn't been through that level of sustainability due diligence because it wasn't a topic at the time. And we've retrospectively looked at our assets and utilizing the FAST label to re-diligence them, identify material sustainability issues, as well as take the opportunity to label assets that provide that positive contribution to society and the economy.
Thank you, James. It's always fantastic to hear from you. You know, it's really where the rubber hits the road. But thanks for taking us through, you know, from a very early stage, how you see the alignment between fiduciary duty and sustainability metrics or resilience metrics, and then how that actually takes place through your thinking and your work as you're seeking to get more finance towards better infrastructure projects. And it leads actually very well to our next speaker, Natalia, from Aon. You know, we often hear this pitfall of when projects get designed, and maybe there's some degree of financing that's secured, but the risk assessment hasn't been done to the extent where the project's insurable. You know, and I've heard you say before that insurability needs to be factored in much earlier than it typically is now. So with the kind of climate risks that are surging and on actually closer than the horizon now, When it comes to insurance, why can it no longer be business as usual?
Well, first of all, thank you so much for the invitation to join the webinar and for this question. And I have to say, Christian always tries to steal my speaking points. So, but I think it doesn't hurt to maybe contextualize just a bit the nature of the challenge that we are facing when it comes to physical climate risk and the dire need to make sure that every new asset that is being built resilient. And every time you're going through a major retrofit, you're thinking about this as well. Christian mentioned that last year in 2024, globally, we've seen $368 billion of total economic losses associated with natural catastrophes and extreme weather events, and only 40% of that was covered by insurance. What I'd like to call out is that that was actually ninth year in a row that $300 billion mark was exceeded associated with these natural catastrophe and extreme weather events. So it seems like this is a problem that's here to stay, and we need to think about what do we do to help drive this trend line down. And I think it's important to recognize that it's not just changing climate that's driving losses up. It's also increases in population, in wealth, overall exposure in high-risk areas that is continuing to drive these losses. And in addition to higher number of people, higher valued assets being located in harm's way, we're also seeing aging municipal infrastructure that was not ever designed, perhaps, to accommodate the type of events that we are seeing today, where you may have months worth of rain falling in a localized area in a matter of hours. We are facing persistent loss of natural assets. Think about all these different studies that have been done to document the effectiveness, for example, of mangroves to help alleviate coastal flooding and hurricane risk, or wetlands and so on. Well, there is persistent loss of natural assets that used to perform this disaster risk reduction function for free. And then there's also lagging adoption of proven measures, adaptation and resilience measures, even when new assets are being built. And that's despite, again, numerous studies that say $1 invested today can help alleviate $10 to $43, depending on the hazard, over a 10-year time frame in terms of disaster cost avoidance. So that's kind of the framing. I think what is positive, though, about this, if you can find something positive, is that there's actually a lot that's in our control to address the challenge. So we can think about where we site the assets, how we build the assets, at least when we're building new assets. And Darius mentioned there's over $94 trillion worth of new assets that have to be built in the next 15 years. So let's make sure we build them right. And the good news is we have catastrophe modeling and forward-looking climate projections already available to inform these siting and design decisions. Most of the architecture and engineering firms have dedicated technical expertise. Many have resiliency teams that can provide thoughts on how to arrive at more robust designs. And thanks to FAST-Infra label and several other standards, there's also that guidance from technical standpoint on what good looks like that investors are beginning to recognize. Credit rating agencies, insurance companies are looking at that as well. But to your point, Louis, what you mentioned is we also need these experts, financial, insurance, legal experts, engineering experts. We need these experts coming together from the outset to understand how to design these comprehensive and efficient risk management programs when new projects are being built. Engineering provides insights on how you can harden the assets. Legal can help figure out ways that you can manage risk contractually. finance directs capital to good de-risk projects, and insurers can contribute data and analytics, loss mitigation strategies, and of course, risk transfer strategies as well. But currently, this is not always happening, that these disciplines are coming together right from the start. And I think this is an area of improvement. How can we get finance, insurance, legal, engineers working together from the outset? FAST-Infra label provides a really good framing on the type of discussions to be had by these different disciplines.
Thanks, Natalia. So, I mean, that was a great summary of the importance of getting all those players together at the beginning of a project, and then what that means throughout the lifetime of the project and the kind of economic impacts that could have. If I turn back to you, James, we talked about your relationship as Dalmore between projects and capital. And we've said, we need to accelerate investment into infrastructure and aim for sustainable infrastructure to become a liquid asset class. So could I ask you now, on the investors' side, what's the influence of Dalmore's practices on their decisions to allocate capital?
Yes, yeah. So our investors are institutional investors, and what we're seeing is they're increasingly aligning their investment strategies with sustainability mandates. And there's a number of drivers for this. First of all, the obvious one, the regulatory requirements, the UK FCA, particularly thinking about sustainability disclosure requirements as well, EU SFDR, and these rising expectations for transparency, accountability, and as well consistency in sustainability reporting. But also another fundamental driver is stakeholder expectations. So we're seeing beneficiaries, civil society, the broader public demanding responsible investment practice and demonstrable social and environmental impact, as well as recognition of the financial materiality of climate and sustainability risk. So that back to that fiduciary duty point. So prompting the need to integrate these factors into investment decision making and risk management frameworks. And in response, these institutional investors are expanding their sustainability objectives. So they're thinking about sustainability beyond those dark green activities where there's very clearly that a substantial contribution to this society and environment, and they're increasingly broadening their spectrum of opportunities. And this is where I feel particularly FAST is very good for recognizing that contribution beyond just the dark green and having that wider sustainability benefit. So thinking about transitional assets, technologies enabling the shift to a low carbon, climate resilient economy, engaging companies that are actively working to improve their sustainability performance, reduce emissions, particularly in high emitting or high impact industries, and also thinking beyond climate as well. So thinking about social infrastructure, nature. So many of the assets that actually we're working at the moment that we're examining in terms of using the FAST label, they're schools, they're hospitals. It's even defense infrastructure, where there's a contribution there that needs to be recognized, as well as highlighting that there's good governance in place and material environmental and social issues are being appropriately managed. And a number of themes are starting to emerge in terms of what investors are thinking about when it comes to allocating capital. So they're thinking about net zero. So, for example, which is an obvious one, but half of local government pension schemes have set net zero targets, which is very much signaling that strong commitment to decarbonisation. But it's not just limited to net zero. They're also thinking about governance and stewardship, that proactive engagement with portfolio companies to strengthen governance, support credible climate strategies, and improve sustainability outcomes, thus providing that greater accountability, transparency, and long-term resilience at the asset level. An interesting dimension as well that we're very much seeing is something termed as place-based impact investing. So particularly going back to those local government pension schemes, they love to invest money in somewhere that has those social and environmental benefits, but in their local communities. That's something that's really attractive. And again, going back to the label, demonstrating that social economic contribution at that local level is a fundamental consideration. And there's emerging priorities as well, thinking about, I don't feel like they're necessarily emerging, but I think they are from an investor point of view, thinking about equality, diversity and inclusion and natural capital. So to answer your question, what's Dalmore's role in sort of meeting that need and facilitating that? So our roles are important because we can mobilize capital across that sustainability spectrum, target those transitional assets, look to improve sustainability performance. Many of our existing labeled assets are assets that are traditionally not necessarily seen as sustainable, but they're industry leaders in climate action or addressing particular sustainability challenges, and that the label recognizes that. So think about emerging infrastructure as well, digital energy storage, EV charging, as well as that social infrastructure. Public-private collaboration is really important. So partnering with government bodies through PPPs, PFIs to unlock investment in essential infrastructure. At the same time, targeting national and regional priorities for infrastructure investments. So we're thinking energy security, water resilience, transport decarbonisation, and defence infrastructure is an interesting topic at the moment, as well as thinking about digital social infrastructure and clean energy. And coming back to the stewardship point as well, I think we, as asset managers, have a fundamental role in driving that stewardship forward and delivering measurable sustainability improvements and embedding sustainability to act as that lever for long-term value creation, as well as I highlighted earlier, thinking about integrating consideration for sustainability in our own investment life cycle and disclosing and demonstrating that tangible impact.
It's actually very reassuring, James, to be getting these positive signals from capital allocators who are ultimately allocating our capital. For anyone who has a pension fund, it's nice to know that they're taking those long-term considerations seriously. Now, for anyone who follows Darius on LinkedIn, you'll know that he's a legendary knowledge disseminator. So Darius, you've worked with a whole range of different institutions across the whole value chain, public, private. With your background, what would you say is needed to reach the scale and pace that we need to build the resilient infrastructure needed? And how should we align all the actors to get the financing required on the table?
Well, thanks for the question, Louis, and thanks very much for the contributions I've heard from our fellow panelists. I'd like to simplify to some extent what we've heard so far and respond to your question in terms of scale and speed. We are now 10 years into the Paris Agreement. There will be a reckoning this year as we think about whether we've achieved the goals of a 1.5 or 2 degree temperature increase over pre-industrial temperatures. We are just a few years away from a reckoning stock take on the SDGs. But even beyond these treaty-based goals, we have an obligation to the future to preserve a livable planet. I think that's ultimately what's underneath these global agreements, and in many ways what motivates James and his work in terms of value creation, and Natalia and her work in terms of value protection and preservation of value over time. So in order to achieve those goals, the deepest purpose of our work, it's worth thinking about how quickly can we reach an objective that will allow us to protect the future. And that means we need to be able to speak to each other in a common language. We need to be able to communicate, coordinate, and accelerate shared action. For any project developer, one of the biggest challenges is how quickly can I get my work done before I run out of cash? How quickly can I get my project completed and financed by someone who I would consider to be a responsible partner, someone I can work with? For the financiers, the question is, how can I find something investable that I can explain to my investment committee is a good idea? For investors, the question is, am I doing the right thing? Am I getting a return that I can be proud of and explain? And am I going to feel good about this investment from a portfolio standpoint and for the future? So these basic questions that investors, portfolio managers, developers, even development banks face every day needs to be answered efficiently. For us to achieve these goals, we have to work fast and together across language barriers, capacity differences, and even currencies. The most efficient way to achieve those goals is to use a common standard, a way of communicating shared objectives. And I think that's the core value that the FAST-Infra label provides, a single meta standard that becomes a reference point for the global community seeking to achieve these goals in a coordinated manner. It becomes easier for everyone to consider if they're building infrastructure, financing it, investing in it, or managing a portfolio, to use the FAST-Infra label as a reference point for those decisions. It massively speeds up the process, it de-risks the physical infrastructure itself, and it makes it much easier, to Christian and Natalia's point, to have confidence and trust in the investment decision. So for speed and scale, simplification and standardization are key. We've seen that every market that's scaled, it creates a basic framework for everyone to share decisions and be confident in the choices they make. We've seen that in green bonds. We've seen that in other asset classes that have scaled rapidly. And I think that's what needs to happen next for the next generation of infrastructure. I'll just make one last point, and that is, with the advent of the technology build out that will be required, the technology and energy build out will be required for an AI facilitated economy, we're going to need to double down on shared standards very quickly. And I think that's a tremendous source of value that FAST-Infra provides to the global community. And I would encourage anyone listening to this webinar, anyone touching the infrastructure investment space, to go to your website, understand what the opportunity is, and begin your work on the basis of this meta standard going forward.
Thank you, Darius. That's very clear call to action. I'm aware of the time, and I'm very eager for us to get some time for questions. So, Natalia, if I ask you very briefly, we've got COP30 around the corner. We've just come out of New York Climate Week a couple weeks back. What are your main takeaways from New York Climate Week, and what should we expect at COP30?
I'm very happy to share. And I think this Climate Week highlighted the themes that we're talking about. Resilience, insurability, investability long-term of assets was prominently discussed. And I don't know, Louis, if I can steal your points kind of as we head into COP30. I thought it was fantastic that Global Infrastructure Basel Foundation, acting as a secretariat for the label, is going to convene an insurance working group that will look at the adaptation and resilience dimension of the label in particular, and understand how the criteria of adaptation and resilience that is part of the label now aligns with the way that insurers and reinsurers think about risk and resiliency benefits. And ultimately, that work will help project developers see the benefits of an improved insurability, improved bankability through the application of FAST-Infra label to the assets that they're building. I think it's critical work, so I applaud you for doing that. I think there were other key points at New York Climate Week that I hope will be translated as we go to COP30. There was an acknowledgement that no industry sector is immune to climate risk, and that companies in all industry sectors have to measure and address the risk. We spoke about this today, that climate risk is a financial risk, and therefore investors and companies have fiduciary responsibility to account and address it. And at the very least, the following questions, I took notes of them, have become kind of de facto what you have to ask if you are investing money on other people's behalf or if you're a risk manager for a company. And these questions are, has the company or project evaluated its vulnerability to physical risk, both today and into the future? Because these risks may evolve into the future. What material risks have been identified, not just for property, but across people, so workforce, operations, and supply chains? What would be the financial impact of worst case scenarios? What are adaptation measures that are in place or could be in place to address these risks? And who is in charge? Who is overseeing and managing these risks? I also think there was another big theme of how every dollar spent on disaster recovery comes with opportunity cost. That spending money on recovery is, of course, really important, but this is the money that could have been spent somewhere else in the economy. And so, again, if we're thinking about prioritizing resilience, it helps perhaps limit some of these disaster recovery costs, and you are able to spend it on education, healthcare, and other places. And then to wrap up the final point, and Darius spoke about this and others at length, that yes, this standardization is really important. What is the signal of higher quality that investors, lenders, insurers, credit rating agencies, governments and communities and other stakeholders can look up to when they're thinking about resilience and proper management of this risk? FAST-Infra label plays an important role in that. Signal this is higher quality versus not. And at the very minimum, as we're building new assets, $94 trillion worth of new potentially assets to be built in the next 15 years, the bare minimum would be doing it right, not repeating mistakes of the past. And FAST label can be a guidance of how to do it.
Right. Thanks so much, Natalia. Now, with not that much time left, let me give you the last word before we then go to questions and answers. So what are your hopes for 10 years after Paris?
Yeah.
Let's
just a quick wrap up first. I think we had a really rich exchange, and we heard from Darius about the challenges that are ahead of us as we are crossing the 6th of the 9 planetary boundaries. We also heard about the challenges in scaling and the role of having a common language and having standardization. I think from James, we've heard about this fundamental link, which was very clear between sustainability and financial performance, which is part of your fiduciary duties, and the value of the label in due diligence, in investment process, in monitoring, reporting, but more importantly, as driver of long-term value creation. I think that was very, very powerful. You also said something which is important, which sometimes we forget. It's that the label is applicable across sectors, social, infrastructure, nature, not only energy. And I think we've also heard from Natalia very convincingly what the cost of ignoring resilience is, and more hopefully, the fact that solutions exist because the topic is becoming front and center. And she also reminded us of the importance of working together. I think just 2 final thoughts on my part. One, I think it's really important that we identify, we extract, and we find ways to monetize the value of doing things differently. So we've got carbon credits on the mitigation side. I think here we need to find financial mechanisms that recognize and reward resilience. And obviously here, believe that insurance has a critical role to play, not only in pricing risk, but also in helping to design and incentivize infrastructure that will withstand the future. My second thought is around the need to strengthen those partnerships that we discussed and strengthen them around the idea of maybe quality that is reflected in policies, in tenders, in procurement guidelines, quality that speaks to sustainability and resilience, not only as an environmental and social necessity, but as a financial one. And I think that if we reach a consensus there, it can be a powerful driver of change. So look, the team is going to be at COP in Brazil. They will be very very active there. So please reach out to them, and let's go straight to the Q&A and hear questions from you. Thank you.
Thank you, Christian. So let's jump straight into it. There's one, the good news is that there's lots of questions. The bad news is there's too many for us to answer all of them. So we really invite you to follow up with us after the webinar as well. But here's the first one. Can the panelists share thoughts on how the FAST-Infra label could be applied in getting an alignment of interest between asset owners, fund managers, and portfolio performance to mobilize more capital? That's number one. And number two, thoughts on new financial products, e.g. new funds and new insurance products linked to the label. So feel free to jump in. Christian, you're on mute. Would you like to start off?
No, I think I was just, my call to action was on the second question. So I don't have an answer yet, but no, I think we can hear from other panelists. It's going to be more interesting. Thanks.
James, do you want to tackle the first one?
Yeah, I'm happy to tackle this. So I think from my perspective, it'd be really interesting if there was thinking from our Dalmore perspective and experience, that if we were mandated by some of our institutional investors to look at alignment with this particular standard or others. Because I think we're broadly following the same sort of principles, but there hasn't, and I've engaged with quite a few asset managers recently on this topic and the role of this label in particular. That if there were those that incentive, that driver, you'd very much see strong uptake and alignment with these principles. Although we're all sort of following these sort of objectives, as I said in my my discussion, that we're very much thinking about how we can respond to those investor sustainability mandates, and the label is very much helping us with that in terms of looking more broadly and holistically at sustainability, both in terms of risk and contributions. So I think it'd be interesting to see how uptake of the label evolves, and whether institutional investors in particular start using this to drive to ensure their sustainability objectives and mandates are then translated right down to the asset level, and then you'll see, I think, asset managers really respond to that at the same time.
And maybe just to add as well on the opportunity side of things. Remember, I think it was last year, December, Tailwind did a study here in the US outlining the investment opportunity associated with adaptation and resilience. And then this year we had several other reports that were published on the adaptation and resilience opportunity. I think there was GIC report. So GIC manages Singapore's official foreign reserves, right, on behalf of the government. BCG, London Stock Exchange Group, McKinsey, different reports were published, and they all kind of outlined that on the flip side, there is a big investment opportunity in adaptation and resilience, and it could be around $1 trillion today. So that is interesting research coming out on the upside of things. As it come regarding insurance and how to think about the label and the linkage there, as I mentioned, there's the new working group that's going to tackle that question specifically, that's being set up. I can't remember when the kickoff call is, in a couple of weeks. So we'll be working on this very closely. Aon is part of that working group. But we did a study recently at Aon, and when we look at global insurers, 68% of them are looking at means to better factoring evolving climate risk. And some leaders in this space are thinking about how do you use these insights to better inform long-term underwriting, pricing, portfolio concentration strategies. How do you leverage your loss control teams today to better advise clients on resilience? So acting as resiliency advisors to help get risk out of the system and improve profitability. How do you create new products to support resilience? Or maybe what kind of endorsements can you introduce to encourage resiliency. For example, some are introducing endorsements to build back better to a higher standard. And then also, how do you engage with communities where you operate to raise awareness at the community level of what could be done to help limit risk? So there's different companies are taking different approaches, but I think the industry is shifting from reactive approaches to being quite strategic on resilience, because we have to do that.
Thanks, Natalia. Just to pick up on that, there's another question here, observing a trend towards the delegation of national or subnational government to infrastructure development to state-owned enterprises. And the impact that has on the way that projects are developed. So if I turn to you, Darius, the question is, how can labels and their labeling criteria reflect the increased impact of project development and minimize risk at that development stage, given the amount of investment that goes into project development now, and maybe these trends towards sort of state-owned enterprise models?
Great. Well, there are a number of aspects to that that are worth pointing out. The first is that much of the infrastructure we build, this 100 trillion of need that we'll see over the next decade or two, will be built at the sub-regional level. We tend to characterize our discussions around climate finance and sustainability at the nation state level, because those are the actors who sign agreements, but much of the decision-making investment takes place within countries and at the subnational, regional, urban level. The infrastructure future we imagine is largely an urban one, at least as much, if not more, than a national one. So engaging urban decision makers who are often undercapacitated, stressed out, underfinanced, and pulled in multiple directions is key. And providing them, therefore, a meta standard that can serve as a shorthand for communication around resilience is absolutely essential for safe and efficient delivery of resilient infrastructure going forward. So there's a huge value of the FAST-Infra label at the sub-regional level. In terms of risk and financeability, I think it's worth highlighting that we are already holding that risk that Natalia and Christian referred to. Just as the loss of stationarity has highlighted the difference between the past and the future in terms of the risk profile we take going forward, the fat tails in terms of climate sensitivity and extreme weather risks, we're holding those risks already in today's portfolio, the global portfolio of infrastructure. And the choice we have, therefore, is how are we going to shift that balance to something that's going to be safer for future generations and a better preservation of value? And that's an intentional choice. So instead of being spectators in this process, we're all actors. Actors who have a set of choices to make around how do we select projects, identify priorities, design those projects in a way that's resilient, finance them, refinance them, and bundle them into portfolios that investors can be proud of and feel safe about. To ensure a future that is insurable, we need to manage that portfolio in a way that is going to be aligned with the much more volatile weather we're likely to see in the future. And that means adopting a meta standard that will allow project developers to efficiently identify and prioritize opportunities and allow financiers to efficiently screen and select those priorities, those priority investments in their projects. And that may be at the sub-regional level, urban level, or national level. As we go into the next round of NDCs coming out of COP30, and as we start looking at transition plans that frame those NDCs, I think having the FAST-Infra label available to developers is going to be essential. And the last thing I'll say is we are on a deadline. This is it's a perfectly labeled standard, FAST-Infra. We're going to be working on a deadline that is set by planetary conditions, not by industry standards in the finance sector. Ultimately, the risk that we're holding derives from the conditions we create with the infrastructure choices we make. And therefore, it's on us to look to the FAST-Infra label as the reference point for those decisions.
Thanks so much, Daria. So that brings us to the end of our time. I'd once again like to thank the panelists very, very much for sharing your insights, and to thank all of the audience for joining us and for your support of the FAST-Infra initiative. We've generated a lot of questions here, a lot of discussion, so that's a great sign. We really look forward to following up with you all. Please feel free to reach out to our team to get involved, for example, to use the label to boost credibility and your due diligence processes, or through other ways. Together, we can really make a huge difference here to the issues that we've discussed. Thank you.
Thank you very much.
Thank you, Louis. Thank you.
Thank you, everybody.